All right. Good morning, everybody. We've got a few speakers this from ECB, European Central Bank, Bank of England, and then here in the US. And they're attempting to maintain the same message that it has been. Although I did hear something this morning. I haven't been able to follow up on it yet. Something about their collective message has changed for a 50 basis point rate hike in December rather than a 75. And I don't have that confirmed yet. I still need to go check a couple of articles and get some consensus on that. But if that's the case, if they do start unwinding the 75 basis points and we lean heavier on that 50 basis points, then we'll see this bar here start to go back up from 85, it'll get into the 90s. That'll almost be an assured or guarantee, as much as we can get those, right? That it'll be a 50 basis point rate hike. But we still have CPI and PPI, from this month that'll be on the table for next month. And it should come, I think PPI will come in right before the December meeting. And that information could sway or change their mind about 50 basis points or 75. So as much as they're all on the docket today and have been through the week trying to share the same message, I think that the December report of the November CPI will be more weighty on their decision than anything else. Global GDP growth dropped. We had some numbers come out yesterday significantly, like from 11 something down to 8 something for the next year. It's projected global GDP. And the market just shrugged it off like it wasn't anything of concern. Well, normally there'd be a summary here. Maybe we're a little early or they're running a little behind. I'm not early, so they must just be behind. Well, I was hoping they were going to cover it in the 5 things you need to know, but it's not there. So yeah, I'll have to just dig around and see. For anybody playing a 0-day trade on a day-to-day basis, one of the things you definitely want to keep your eye on is the clock. It's free, and it's one of the most powerful indicators that you could use as a trader. These additional auctions that come in, we have 11, 11:30, and 1 o'clock. These things will run you over if you're not watching out. Can't tell you how many times I've seen a market go from, moving to the downside to moving to the upside, or from breaking a range into trend, ending a trend and going into range, all because of these auctions. They don't get enough attention out in the world. I really think I'm the only one that ever talks about them. But if you're going to trade 0-day trades and there's no auction in the afternoon, you're pretty much free to go as soon as you can identify lunch has ended. But when you have an additional auction at 1 o'clock like we do today, and it's a good one, it's a 10-year auction, and it's the tips too, you're going to want to wait on your 0-day trade and don't put it on until after that auction, say 1:15 or so, to see what the outcome or what the reaction from the market's going to be before you put your 0-day on. One thing I've learned is never start a 0-day during the lunch range. And two, when you are done with lunch, if there's an additional auction like there is today, wait for that thing to come out before you put on your 0-day trade. I mentioned yesterday that Head and Shoulders measured move is done. There's nothing else left in it, which now leaves us without a pattern. And we're just in this range here, which creates an IX10. And as we're going to see in a minute, when we go over to the ES futures, we're not in this range anymore, but in the SPX this morning we are. So, we do have Econ on deck, but it's very likely that we're going to open gapped down outside of this range. There is a gap down there that needs to be filled. 38.60 is going to become a magnet. It's the starting point for the channel. We closed down here, and the next day we opened up there, and that is the gap that needs to close. Now, some analysts will just use this candle. They won't care if it's the open or the close. As soon as price comes down and tags that candle anywhere, they'll say, oh, the gap is closed. I don't do it that way. I'm not going to say that they're wrong and I'm right, because there's more than one way to get the job done. I'm just going to say I don't do it that way. So what I would recommend is at least mark out, recognize that when we get down to that candle, and we're not going to be there today likely, but when we do get back down to that candle, whether it was an open or a close, price very likely will respond at that level. Plus, on this one, it's a cog line, 38.11. So we know price is going to respond there. But as far as I'm concerned, the gap's not closed until we get down to 37.48. That would also get us back inside the box. The hurt locker, the volatility box. So at the moment, what we have on deck today is a potential Busby. Busby is a phrase that I came up with because I got tired of saying the same thing over and over, which is old resistance becomes new support. And very often when price does break out of a resistance area, it very often pulls back to that same spot and validates it as a new support. That's a whole lot of talking, when what we could just say is, we have a Busby. I think we've all seen where price will challenge a range or a zone or a pivot, and then it finally breaks out. When it comes back and challenges that old resistance and validates it as new support, that is the Busby. And the only thing it owes you is back to the top. So you look for an entry around here and you get out of most of your position before it gets to the top. The reason that the Busby is such a powerful thing, though, is most great trends start with a Busby. So whether you trade the Busby or not is irrelevant. Recognizing that the Busby is very, very often the start of a trend is really important. That's the powerful piece. So we're looking for it to come down and tag the top of the box, tag this resistance zone that we had at 3,900. And if we're going to bounce, that's where the bounce is going to happen. Right? So it's the easiest way to approach it. I don't know it's going to bounce. Nobody knows if it's going to bounce. We don't even need to guess or assume that it's going to bounce. If there is going to be a bounce, it'll be at 3,900. Now, looking at the ES, the box is a little bit different. The location of it is a little bit different. The top of the box is 3,925, not 3,900. So whether you're in the SPX or the ES, it's the same pattern, just the top of the box is at a different location. So the bounce would be at a different location. The Busby would be at a different location. Now we can overshoot 3,925. It's not the idea that we can't go below it. It's the idea that we can't close below it on a daily time frame. So today, if we go below 3,925, it doesn't immediately mean that the Busby failed. But if we close below that today, then the Busby I would consider to be irrelevant at that point. We would just dismiss it, move on to the next thing. It appears that the 200 period exponential moving average was the resistance, just like it was back here. We didn't get into the 200 SMA. We failed to get through and hold above the EMA. It's fine. At least we know what it is. We still have the 10 period as a support coming up at 39.17. And on a weekly, we have a 20 period moving average at 39.12. Call it 39.11 because it's a cog line. So you got a 20 period weekly moving average at 39.11 today. Really just keep track of the cog lines at this point and you'll be just fine, right? Because the cog lines at 39.11, a major weekly moving average is at 39.11, done, right? That's a wrap, no problem. The 10 week isn't our concern at the moment because of its distance. We're going to deal with the 21st, but the 10-day is at 39.17. So that's 2 pivot points we want to add to the chart today, 39.17. And of course, you got the 39.11 already. we are at the ADR half this morning. The ADR is 2.36%. It's around 92 points, almost 93 points. We're getting close to the weekly pivot, which is at 39.15. And volume this morning is within normal ranges, so we can turn the volume off. We don't need that cumulative volume down there. The next ADR point would be 38.84. We could move all the way down there and it still wouldn't be considered an outsized move. That would just be a normal day, a normal trip to the fridge to get another drink. Right? So S&P moving down 38.84, that's nothing. But to get there, we've got a couple of significant pivot points to get through. First, the ADR half, and then the weekly pivot point. The 10-day moving average cog line with a 10-week or 20-week, 20-week, and then that ADR. Now, I said the other day that with the head and shoulders done, we were done with any pattern. We didn't have anything that would continue to propel us higher, but that if we did break higher than this high from the other day, we would very likely go up and finish closing the gap. Well, we didn't continue to go up, obviously. We're headed to the downside, and that means we're going to focus on that lower gap that I had mentioned. So yesterday, we kept looking for the play. And while we did have a reasonably decent opportunity occasionally showing up, it wasn't solid signals. And one of the reasons that we didn't get good, clean, solid signals yesterday, or we never really got a good trade yesterday, was the weighted AD not leaving the 500. So this 500 zone on the downside, minus 500, we get below that, then we know we can get into some directional trades. As long as we're staying inside the 500, and usually it's -5 to +5, then we're going to be expecting a range-bound day. The iron condors, vertical spreads, butterflies, things like that. We had a head and shoulders inverted show up yesterday, and it gave us the measured move, only the measured move too, and only half, 50% of the measured move. So it's a great example that it doesn't owe you 100%. And it's why we mark out 50% of the move and then 100% of the move. And another example that as soon as the measured move was done, so was us going up, right? It completed the pattern. The market dumped out after that. All right, I mentioned yesterday that if we broke below Tuesday's low, we were very likely going to pick up speed and move quickly to the downside because there's nothing down here. Well, we have broke that level, and we are now falling into that air pocket of risk that I had mentioned. It's this big area here. we're moving farther away from the center of gravity, the point of control, and we're moving through an air pocket of risk. There's nothing here to catch us or help us. So other than our own pivot points that we just talked about and marked out, there really isn't anything around. The thing about having a range, though, is a range is a pattern, and a pattern can be measured. So from that perspective, we could measure the size of this rectangle and then plot those measurements out, 50%, 100%. We can also mark out 50% of that really big candle. $38.65. Got to adjust just a little bit for that wick. $38.62. So that midpoint, 50% of this really big candle, becomes a target to focus on. Normally with this big candle, we would also project to the upside and to the downside, but there's no reason to project right now since we're inside that candle. Now, I've read some books on analysis with these measured moves inside of a range or a candle like this, that we could, for an example, add quarters. So, 0.75 curve and 0.25 curve. I'm not going to say that they're worthless or that I don't do it. Right? I just don't find value in it. But there are analysis books that talk about the value of doing that. So, decide for yourself. Maybe mark them out, lighten their shade a little bit so that they're not so in your face, and use them enough to where you can make an informed decision for yourself if you like them or not. At the very least, recognize that when we get to one of those measurements, 25% or 75%, that you could see a reaction out of the market, right? At the very least, it doesn't cost you anything to mark it out. In fact, the 50% lines up with our 10-day. And like I've talked about before, when your analysis overlaps from different places, when all of the data leads you to the same destination, when you got to that data point from different tools, it gives your analysis more strength, right? Because what you want to try to avoid is multi-collinearity, which is basically the psychology phrase for an echo chamber, something you hear about a lot in politics. If you have 9 indicators all telling you to buy, but all 9 of those was looking at volume, for an example, but was not looking at price and volatility, momentum, or trend, but was only looking at volume, you would believe, oh, wow, these 9 indicators are all telling me to buy. I guess I should buy. When in reality, we're only looking at one data point just presented to you 9 different ways, multi-collinearity. So when your analysis can lead you to the same conclusion, but you're getting the data from different sources, then your analysis has more strength and structure. So that 10-day MA at 39.18, that's a solid pivot point that we've found now from multiple sources. It also lines up with this little bit of volume shelf. It's not much, but it's all we got. So anticipate a first bounce play at 39.20. First bounce only owes you, say, 7 to 10 points, but with enough contracts, those 7 or 10 points is day done, right? That's a mortgage payment. We don't have any VPOC to carry forward from yesterday. but we do have one from 11:10, and it's at 39.13. So just a little bit lower than the 10 MA that we were talking about, and a little bit higher than the COG line at 39.11. We have K-Web and emerging markets both down this morning. And behind that, energy, technology, industrials, bonds again, with a little disappointing, gold, financials, and then semiconductors. And it's a little surprising to see semiconductors as the ETF being down, when from what I was listening this morning, and I haven't checked on NVIDIA, I guess I should real quick. Yeah, NVIDIA didn't crash and burn. So, you know, it's kind of surprised that semis are down. AMD, MU, TSM, yeah, they're weak. Doesn't really match what we're seeing here in the ETF, but yeah. With this many names down, it's often easier just to see, well, what is up this morning? What's that? Natural gas, solar. Nope, those are flat. Natural gas. That's it. And it keeps fluctuating. So let's go take a look at it. Let's see. Yeah, it was up. It's giving it all back. Couldn't make it through this pivot point from Monday. Still sitting inside the range. The hurt locker, the volatility box, call it what you want. Now, XLE is forming this trade strategy that I thought came out of hit and run trading, but when I looked, it wasn't there. It must be somewhere else. I still can't remember where I found it. Maybe Trade Gauge or something like that. It's a strategy that's been around for a long time. Basically, what it focuses on is you set a yearly high, the market pulls back on, does its thing for a while, comes back up. So we've got this cup formed. Well, when you break into a new high on the year, what you often get is like the first reflexive action is that it just comes right back in again. But after consolidating for a few days, it'll yet again break out and make another run for it. Kind of like what happened, say, right in this area, where price came up, hit it, pulled back a little bit, tested against it, and then finally took off. It's if you go looking around on the web or YouTube, whatever, it would be 52-week high breakout strategies, any kind of phrase like that you're Googling. The one that I focus on is really great for stock traders, not necessarily for options traders. So you would every day near the open, you would put a buy order in 2 pennies higher than the highest point made in that 52-week high breakout. If by 10:30 you have not yet gotten filled, then you cancel your order and you wait until the next day to do it. And you keep doing that until one of two things happen. We break out and your order gets filled, or the market dumps down like it did, back here. Obviously, you don't need the order when we fall away like that. It's just one strategy. It's a very simple one. It's a kind of a hands-off thing because it doesn't require a whole lot of extra thought or conviction in it. It's great for pyramid traders. If you're going to position in through a pyramid, say you start at 25% and then, you bring in another 20, 30, whatever, right? You slowly build your position as the position continues to work. Now, it's always different to trade shares when it comes to, the way most of us trade options nowadays. And there was a lot of upgrades and downgrades this morning. I didn't catch them all. It's been a kind of a busy morning. But the thing about analyst upgrades and analyst downgrades that I like the most is hearing something that gets a downgrade and seeing it go up, or hearing something get an upgrade and seeing it go down. When it bucks the system and goes against the grain of the analyst. When it comes to those analyst upgrades, or at least analyst rate changes, who the analyst is becomes very important. If it's some no-name Joe Schmo analyst that you've never heard of, they really probably won't have much weight out there. But if it's a popular, well-known analyst or a well-known firm, they can have a lot more weight to it. Yeah, see, I must have misheard. I thought I heard some better names than this. I see Target on there, Lowe's, Nvidia, but those weren't the ones I was looking for. The rest of these getting analyst upgrades or downgrades, yeah, I mean, unless you're holding a position already in some of those, I wouldn't focus on most of those. Ah. So BJ's has been a great trade this year, and they just revised their earnings, their forward guidance. We could be seeing an opportunity for a new breakout on the year. That would be a long-term trade, something that you wouldn't want to focus on too much on like a day-to-day basis. It's more of the big picture. And that's a wrap for those. Have a significant gap down in silver. We don't have a silver volatility gauge like we do on gold. And since both of those precious metals tend to move kind of in the same vein, seeing a move in silver, I automatically want to see what the volume, or excuse me, the volatility looks like. So we're using GVZ, which is a volatility indicator for gold. And we had that spike the other day, nothing yesterday. And then of course, it's pre-market, so we can't see anything on a daily for that. We're at 19.20 this morning, so we've gapped down about 50 cents. Right below a minor pivot point. It's a monthly high. If you're looking for an opportunity in silver, or you're already in it as a long, 1875 is your line in the sand. You don't want it to fall back below that, or you're wrong. You shouldn't be long in it. If we break below 1875, that'd be a solid short. I know it looks like a long ways down, but if you're taking a swing, you wouldn't want to use the daily per se anyways. And if you're going to use options, you don't have to wait for it to get all the way down there. You could just put on something like a call credit spread somewhere around, say, $20 for your break even. We've seen some significant moves in US dollar China yesterday. We got close to this monthly level, and I was watching for a play in the ES if we got there yesterday and rejected, but we didn't get there yesterday. We actually rejected it early and fell off. The idea being that if we rejected there and fell off, the dollar would reject and fall down, the S&P would rally. And I mean, that it didn't work out, right? But that was the plan when I seen it making this breakout run towards my monthly level. We really had this nice setup, and then it all unraveled since we didn't get there and fell away early. But we're there this morning. That's a significant level of resistance in US dollar China, and we would anticipate a reaction out of the dollar. If we reject here, we're also going to expect the dollar to reject. And as you can see, the run up this morning, we had the run up in the dollar, and the run up in the dollar causes a fall down in the S&P and the NASDAQ. So this is a critical level. If we get above it, we're likely to see the dollar continue to go up as well. We could get back above, say, the 108 area in the dollar. We're coming into that high from the 15th. We're just not yet closing above it. But if we get above 107, which would be that high, target's going to be 108. But the dollar needs US dollar China to get through this major monthly level. So, it's why we look at all the different parts, right? If you're trying to trade in the ES futures, don't just sit there looking at an ES futures chart. It's going to be the last thing to tell you what's going on, right? Got to look at why is it moving. The VIX is waking up a little bit. We're back up to that $25 mark. 25.20 is a major level in the VIX. So if we can get above 25.20, we're going to expect the S&P to continue that downward move, not just hold the line like we did yesterday. This is the last monthly level that I have for US China for a while. So if we get through that level, we don't have anything except a pivot minor, and it's a long ways off. Same thing with US dollar Japan. It rested on that major level that I've got marked, 138.95. It came down to that. It's been holding that major level. A break to the upside. We've got a pivot minor to deal with if we get IX10. So there's our IX10 breakout. If we can get through the breakout, call it 140.75. Then we've got this pivot minor. And then that pivot minor, and then up to a quarterly level. So US dollar Japan getting back above 145, which is Bank of Japan's benchmark line in the sand. They made it clear they don't want it above 145 and they're willing to defend it, but we're not there yet. If they're smart, they'll defend it before it gets there, right? You want to think about pushing a boulder down a mountain. If it's just starting to fall, you could arrest the fall pretty easy. But once it starts to tumble and really pick up speed, slowing that boulder down would be a very hard task, right? You're very likely to just get run over. So if they're looking to defend this, it would make sense for them to defend it before it gets back above 145. Right now, we're just going to focus on the IX10 breaking out of this range. So watch US dollar China at 140.75 and US dollar Japan. And then for US dollar China, once we get above this major monthly level that I've got marked out at 717, we've got a pivot minor at 718. Through that, we don't really have anything else till we start messing around with this trash back here. Hopefully we don't see any of that today, because if we move that strong that far today, the dollar is going to go like 108, 108 half, and that's going to send the S&P NASDAQ down significantly. All right, 10-year Treasury down this morning as well. Don't forget, we got the 10-year auction today, tips at 1 o'clock. With everything else dropping this morning, we're going to expect to see this turn around, go back the other direction. All right, there it goes. That makes more sense. You know, seeing it down on TrendSpider didn't really make a lot of sense. Now it's registering that move up. So we closed it down here. We're gapped up above the open of yesterday and the high of yesterday, at least the cash high of yesterday. So you're looking at a TNX inside day breakout gap up play. Red to green. And $38 is going to be the first level of concern. That'll close the gap because it didn't get closed yesterday. It missed. And it doesn't look like much, but a miss is a miss. So the idea will be first to close that gap and then close the other gap, which is where we have this major line at 38.83. So rising yields this morning, rising dollar, US dollar China, US dollar Japan, and falling S&P, falling NASDAQ, rising VIX. We want to identify a high correlation coefficient as we come into the open. Nah. All right, simple question. How many names in the NASDAQ are down at least 0.5%? 51. So 51% of the NASDAQ 100 is down by at least 0.5% this morning. That's not bad. That's not as high as I would expect it to be. So we want to see that number pick up. When we think about a rising tide lifts all boats, then we really need to see all the boats, right? We don't want to see it kind of hitting and missing different sectors, different industries, different names. We want them all moving in the same direction at the same time. For the S&P, 57% of the S&P 100 is down this morning by at least 0.5%. The major difference between these two indexes is that the S&P has financials and the NASDAQ 100 does not have financials. So as soon as I turn it on to the S&P, I immediately start looking for financials because they'll be the major distinction between those two indexes. They both have tech, you know, they both have consumer discretionary, consumer staples, consumer, you know, just they've kind of spread out nicely between the two, but not finance. I'm seeing a lot of monsters of tech in there this morning. And then there's our group. Wells Fargo, Bank of America, JP Morgan. And then, of course, you know, Citigroup, Capital One, Schwab, Morgan Stanley. The thing about financials is I kind of usually end up having to put them in a little group like cousins. So start with XLF. These three, JP Morgan, Bank of America, and Wells Fargo, very, very often have identical charts, identical setups, identical moves. And then down below, you got your Morgan Stanley, Goldman Sachs, and Citigroup, and they'll often move as a group, have very similar charts, have very similar setups at the same time. Now, all 6 of these can be bullish, all 6 can be bearish. But if I see, say, a breakout in JP Morgan, but it hasn't yet happened in Bank of America, then I can play the Bank of America breakout anticipating that it's going to do what JP Morgan just did, or, Wells Fargo. This morning, it's Bank of America leading, and then Wells Fargo and JP Morgan's kind of following behind it. The bulk of the volume or the trading this morning is here. We can see, clear, clean candles. There's actually volume coming through here. Just transactions, two-sided. Whereas more on JP Morgan, they're just spot plays, right? Like, it's not a lot of volume in there, but it's already made the move. Same thing with either one of these three down at the bottom. Whichever one moves first, it kind of gives you a heads up that, hey, you could probably play the same play in one of the other two names because it hasn't caught up with its peer. Goldman's expensive. Citi's way cheaper. And the middle one would be Morgan Stanley. But all three of these have kind of crappy options. I mean, if you're an options trader and you know what you're looking for, these don't inspire a lot of confidence when it comes to having good, clean options to trade. Doesn't mean I won't trade them, but they're not usually the top of my list. Bank of America, JP Morgan, and Wells Fargo tend to have better options. Bank of America is my preferred go-to out of those three. It's the cheapest. It usually is a lot more liquid, and it's just better options out of all of these. I'd rather play Bank of America. Ones that I don't trade, but I find very valuable through the day is KRE. This is regional banks. It's not so diverse as XLF, but none of these have options that I want to trade. So I don't trade any of these names, but I certainly watch KRE all day long to see what's going on in the financials. These are just not, they don't meet my liquidity requirements to trade in there. As a swing trade, yeah, maybe possibly, but not for day trading. And as you can see this morning, they're just not getting any real volume in there, right? Spot prices, that's about it. So not enough. All right, we had that really nice trend line breakover in gold. We've come into that resistance level. It's hard to see a path forward here, especially with what we're seeing in US dollar and Japan, US dollar, China. I'd say we don't have enough yet, but my instinct would be that we're probably going to end up running those back down 155 and then down to 150 again. I'd watch that 160 as a significant level. After that should be fine for the continued move to the downside. Crypto continues to be a sell the rip. So anything in there that offers you an opportunity would still be a new short. And for swing trades, I mean, they've got a long ways to go. All right, so here's our rejection this morning. That level that I was talking about, this is the play that I was trying to catch yesterday, but it never unfolded. And I just, it's fine. You don't get a trade, win or lose. You don't get a trade. There's nothing to worry about. So I didn't get to trade it yesterday. And now I'm live streaming, so I'm not trading it here. But there's the rejection. And there's the dollar responding with it. And there's your play in the S&P. But that's not much of a follow through compared to the rejection we just saw here, right? So it's not really giving up much yet. Be cautious on this little move up. That is the same as that is the same as that, and it has nothing to do with this in its movement. All right, so we're going to really need this to break down to see the S&P get back above, call it 39, 35 and higher. We need the follow through. And that's been part of the issue over the last few days is we've seen these moves in the pairs and we've seen the moves in the dollar, and then we're not seeing the response in the market. And, normally we would. So it's the idea that nothing works all the time, right? And that there's something seriously broken, something seriously wrong. We're not getting the follow through in the algos the way that we're supposed to. Well, I don't know what to do about that. Just realize that we're not seeing the same results. That would still give you a good 10-point move, and 10 points is more than enough to get day done, but you can't trust that if you're not getting the follow through, right? So like a first touch bounce is just about all you have. For a rebounding rally this morning, you're going to want to see the dollar back below 106.5. And you're going to want to see US dollar Japan, US dollar China really calm down. They don't have to break significant downside levels. They just need to calm down and not really continue those upside moves. So yeah, look at this move in US dollar Japan. We're certainly not seeing the same reciprocation across the dollar and an inverse correlation in the S&P. Not like we should. So maybe we're just running things too tight, that we need to broaden the levels out a little bit and use bigger benchmarks. It's the only thing that I could say to do right now that might even remotely help. So US dollar Japan. Rather than focusing on the flow, pushing it to the upside, focus more on the benchmarks. Say above 141. That would very likely push the dollar up above that 106, 107. That would send the S&P down into another level. VIX getting back above, say, 26. Well, you can see we hit it the other day, but we didn't stick the move. So a significant break above 26 and closing above 26. TNX back above, call it 38 as a good starting point, and then 38.5. getting through this major level at 38.83 would be awesome, but I just don't see that today. And that should get us through this IX10 with the break to the downside and the run towards 39.09. And remember, that's the 50% mark. As long as we're holding above this 50% mark, the market's not bearish. Swing trade wise, you wouldn't want to go out and load up on a bunch of shorts if the S&P is still holding above 39.09. So new short trades in Tesla and Microsoft and Apple and all those, I wouldn't go out and load any until we can break and close below that level. Otherwise, because we're still bullish if we are still above that line in the sand. That's what I got for you guys. Be careful, be safe, keep your eye on the clock. We have a lot of auctions today, and we have a lot of economic data today, and we have a lot of Fed speakers today. So watch the clock, watch the news, validate your trades by looking at other objects. I'll see y'all tomorrow.